Now, I'd like to welcome into the conversation Jed Ellerbroek to join us today with some broader market thoughts. And Jed, you're portfolio manager at Argent Capital Management, but just some takeaways from the data we've received this week and also the market's response to that data.
Yeah, I feel like we continue to see lots of new data center commitment and building announcements. OpenAI is agreeing to fund a lot of these. We've seen a lot of news related to Oracle and some of the other neoclouds. And just generally speaking, AI infrastructure investment remains feverish and growing rapidly year over year.
And Jed, as far as AI and the AI trade, what role is that playing in sort of this ongoing rally that we've seen?
Yeah, it's playing a dramatic role, a leading role in markets. Over the last 3 years, AI-exposed companies account for the majority of the increase in the stock market. It accounts for nearly all of the incremental CapEx growth in the S&P 500. And so it has been driving markets for a long time. That goes for the current day as well. And I think it's going to be a huge factor in this earnings season coming up here in the next few weeks.
And let's talk about Nvidia and this broader OpenAI story. So many of these tech names to break down, but I want to focus on Nvidia here. We've had a lot of commentary on this deal between Nvidia and OpenAI, and I want to know your thoughts on who's the biggest benefactor to this deal, and is it a good deal for Nvidia? Because I think there's no argument it's a good deal for OpenAI.
Yeah. Some criticism over the circular aspects of this acquisition, or of this deal, excuse me. OpenAI is signing up to buy a lot of chips from Nvidia at the same time as Nvidia is making a large investment in OpenAI. So the natural question is, well, geez, is Nvidia just financing purchases of its own goods to benefit its income statement short term, and then leaving a potentially huge, long-term risk? I think of it a little bit differently. I think that NVIDIA's making dozens and dozens of investments in AI native companies. They've been doing that for years. They're going to keep doing that. I think the company made over 50 individual investments in VC-backed AI companies in 2024, and they'll probably doing more this year. Obviously, the OpenAI one is the largest in terms of dollar amount, at 100 billion. But I think it just continues the pattern that NVIDIA's, been after for a long time. AI is new. They have a front row seat to a lot of the innovation and wonderful tools that are being built and software products that are arriving on the market. And they're not just standing by and watching it. They're actively investing in those companies. I think they've made some wonderful investments. CRWV is one. There's so many others. And then, of course, OpenAI is shifting from relying on partners to build and operate data centers in which they train their newest models. They started with Microsoft, of course, and are now transitioning to Oracle for upcoming generations of their models. And then the third phase will be them owning and operating their own data centers. And that's what this order from NVIDIA relates to, starting in late 2026. So I think it's a natural evolution. I think this deal is a rational, smart move from both companies' perspectives, and I think it's mutually beneficial.
And beyond being beneficial to both of them, you brought CoreWeave into the conversation too. There are a lot of other players in this AI boom here. So outside of those big names, where else are you focusing? Is there a need to focus in the infrastructure build out itself? Is there a need to focus in the energy needed to supply the data centers once they're built? I mean, this AI expansion goes far beyond some of these big names we're constantly talking about.
Yeah, it does. I think the best performing AI stocks are those with, infrastructure exposure. NVIDIA, data center, building contractors, a lot of the unregulated power businesses, Talon, Constellation, et cetera. An area that is less discovered and has been underperforming recently are software businesses that are going to layer AI functionality on top of their existing products. ServiceNow is one example of that. ServiceNow is a tremendous company. They're growing about 20% annually. There is great potential for AI functionality to make their products better. And I think they are now selling, in the market, those products to existing customers today. That's a cross-sell motion that's, I think going to be successful. It just takes time. These software companies introduce new tools, start off with a small charge or no upcharge at all. And then as customers get hooked on them and realize how wonderful they are for productivity or new enhancements to the top line, they're willing to pay for them more. So I think that the software rollout of AI tools is early, but I think it's going to happen, and I think it's an underappreciated story looking out over the next 2 or 3 years. And there are several software companies we've invested in that we think will be beneficiaries of that trend.
And software and SaaS, just sort of on the whole, have been, maybe a bit out of favor of late. So you think they still can be of favor as long as they're putting this AI application on top of whatever services they're offering?
Yeah, that's right. I think if you're an AI or if you're a software business and you have, a material advantage in terms of data and market share over your peers, that's going to make your AI products better than alternatives. And so I think about, ServiceNow, dominant market share in IT service management for large enterprises. I think they're ideally positioned to tack on AI services on top of their existing offerings, cross-sell that to consumers, and continue to grow their revenues. I think what investors want to see, though, is accelerating revenue growth. And the software companies aren't there yet. I think they will be in the next year or so.
All right, and I know beyond what we've already talked about in the AI play, you've got some other stock picks, Blackstone being the first one. Walk us through that.
Yeah, sure. I think that this is an almost ideal market environment and economy for Blackstone in particular, but also alternative investment managers as a whole. Credit spreads are tight, equity markets are strong, IPO activity is coming back. The Fed is lowering interest rates, which is wonderful for private equity businesses, but also real estate, investment businesses. Blackstone is a huge provider of both private equity and real estate investments. So we've seen Blackstone stock do well. I think it'll continue to do well. And I expect a big, earnings growth year next year as the IPO markets stay open. Blackstone is going to bring a lot of companies to market. They're investing aggressively in some of the big kind of thematic areas that they think are going to be important for the economy. Data center is one of them. So yeah, we foresee a lot of good news for this entire space, but Blackstone in particular is our favorite.
All right, and then your next one, Amazon. We got some big news from Amazon settling this FTC lawsuit that's been ongoing since 2023 yesterday. $2.5 billion fine there, but it's Amazon. So just a drop in the bucket for them. Walk us through this pick.
Yeah, you never like to see a company you own get fined by the federal government, but it is good to put that big kind of legal overhang behind them. Generally speaking, we like Amazon because we think both of their businesses have wonderful growth prospects. The first, the consumer retail business that we all know and love and receive packages on our doorstep every day, they continue to outgrow all of their peers. They're one of three kind of big retailers that are outgrowing just about everybody else. That includes Amazon, Costco, which you mentioned earlier, and then Walmart is the third. Big is winning in consumer retail in the United States, and I'm confident that'll continue. You have the additional cost savings opportunity within the retail business by deploying robotics across their warehouse network and also by deploying refrigerated capacity in those warehouses, which is going to enable them to deliver more perishable grocery items to consumers, which has been a huge focus for Amazon for years and years at this point. And then over on the AWS side, we expect that so important accelerating organic growth to develop. Microsoft showed investors that last quarter. Microsoft stock did very well after they reported that quarter. Google did the same with their GCP business. Amazon is going to join the party in terms of cloud computing, accelerating organic revenue growth here, I think, in the next quarter or two. And I believe that'll be well received by investors.
And Jed, we have a retail conversation specifically about Costco coming up later in the show, but do you have a retail favorite?
Yeah. I think Walmart and Costco are both well positioned. The negative from investor perspective on Costco is that it carries a high valuation. It's a well-loved stock, but gosh, they're doing so well competitively. Their comps in the 6 to 7% neighborhood is unmatched basically within retail outside of Amazon, and I think they're managing the membership base really successfully and just doing a great job operating the business. So I would expect both Costco and Walmart will do well in the future. If you made me pick one, Costco or Walmart today, I think I would probably choose Walmart. The valuation is a little bit cheaper, And they have some stakes in some overseas retail businesses that might be monetized in the next couple of years. That's, kind of an area of hidden value for that stock.
Well, Jed, we appreciate you being with us today to talk the broad economy with some stock picks and a lot we've got through today. A very fascinating chat. We appreciate it again. That's Jed Ellerbrook, from portfolio manager at Argent Capital Management.